This week we are coming out with two interesting webinars, and the first webinar is what should you do when the market goes nowhere, the investment strategies that work. And the second webinar is women's only webinar, that is Kodishwari webinar, investing between market chaos, where we discuss on how to navigate through market hurdles for your investment journey. To join the webinar, click the link in the description.
Is index investing enough? You would have read everywhere that it is enough for you to do index investing. Now, the whole case for index investing comes from cost. The principle is that a passive product, which is an index product, will be very cheap. You don't have to pay much. It's hassle-free to buy it, and you can own it as long as you want to. And whenever you want, you can put more money into an index product without having to worry too much. But the clincher is cost. But are we really looking at the whole idea of index investing in a holistic way? Firstly, how do companies get into the index and how do they leave the index? Let's talk about that for a bit. When companies significantly increase their market capitalization, then they move from one category into a higher category. A small cap will become a mid cap will become a large cap. And when a company increases its market capitalization to become one of the top 50 companies, the chances are that it would get included in the Nifty 50. So when the market cap keeps rising above a certain threshold, a company qualifies to go into the next higher index. It's as simple as that. Clearly, a company comes into an index only after the valuation has gone up significantly. Now, if you are an index investor, you will be buying this company after it has risen significantly in valuation and been brought into the index. For example, sometime from now, Max Healthcare and Indigo are likely to come into the index, and they would replace Hero MotoCorp and IndusInd Bank. Now look at the valuation of the companies coming in, and they would be very close to their historic peak valuation. And look at the companies that are going out, they would be significantly lower in their valuation than their historic highs. It's a general thing. It may not apply to all companies, but most of the companies. So what would an index fund do? It will sell the companies which are going out at low valuation and buy the companies that are coming in at a very high valuation. And then subsequently, if you add money, money will keep on going into these companies whose valuation is already stretched and elevated. Now, this is what we do in indexing. So, the valuation of your portfolio, if it is an index product, may actually be elevated more than what should give you comfort as an investor. On the contrary, if you are an active investor, you have a choice to leave out all these companies and buy companies which are aligning with what you think offer reasonable value as an investor. When you do indexing, you don't have that choice. You don't have that option. And if you look at a market like India, where companies keep coming into the index when their valuation is extremely stretched, and companies leave the index when the valuation is low, your portfolio valuation keeps becoming more and more expensive over time, especially in a rising market. You don't give yourself a choice to invest in conservative valuation. So effectively, you pay a higher price to the portfolio, which in turn inflicts a cost on you, and that cost is definitely higher than the differential cost between an active mutual fund and an index fund. That will be definitely higher. And you don't control the quality of the portfolio, especially in a time like now when the companies that have got into the index in the last 2-3 years definitely make the index look more expensive and riskier. So your portfolio will align with that. As an investor, I think that it's very important that your portfolio risks should be controlled and managed more effectively than how an index fund today manages portfolio risk. Because the way in which the indices are constructed and the way in which changes are made to the indices by itself is a significant risk to the investor. And the money saved because it is a passive product is definitely not adequate to compensate for the risks associated with the portfolio composition. And I am very certain that a passive product, when managed like this, actually presents a higher risk than an active product which can be conservatively run by a fund manager. And the costs in that active mutual fund may look optically higher, but if the manager is a very sensible investor, you will not see drawdowns which are very sharp. You will see that the outperformance is high both on the upside and the downside, and the portfolio is very robust and resilient. Now, if a fund manager can bring all these virtues into an active product, I see no case to do index investing in India. Also, when capital goes into an index based on very high liquidity and the need to deploy capital, then it further distorts the valuations in that index and further adds to the risk of the investor. This, I think, is strictly avoidable. If the risks are high in Nifty, as you go down, they are actually higher. There is a small cap fund which is trading at such a elevated valuation. You have the mid cap fund which has concentration risk because the number of scrips is restricted. And almost all these companies are overvalued. So as you go down from large cap, the risk in index investing actually goes up significantly. And these are things that investors who like index investing a lot don't consider adequately. And I would think it is important for an investor to consider what the risks are, to look at the subject holistically and then make a call whether he should do index investing. As an investor, I am not a fan of index investing. I like to curate portfolios which are active portfolios where the risk management is dynamic and valuations drive decisions. I don't want liquidity and index composition to override valuation and force me to buy businesses which are exceptionally overvalued, because someday I know that I will pay the price for it. And I don't want to pay the price for a badly constructed index. And in a country like India, several indexes are not constructed well, and I would say are badly constructed. As an investor, you need to know when to stay away from a badly constructed index, and you need to know to find a better alternative to such index investing. Thank you for watching this video.